Hello, folks. It's David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Welcome to another installment of our Market Trends webinar. Going to be starting here. Just show some quick disclosures. Going to share a few things in our chat as well. Just some of the disclosures and important information. Sorry. Let me go back to this. All right. So remember, if you go to tradestation.com, go to the top of the homepage, there's a button for the Insights blog. And our Market Insights blog that contains a lot of information that we're going to be covering today. There's an article on that blog, um, the top one right there, and it has a lot of the information we're going to be going over. If you want to go ahead and jump to that, just kind of looking, we have a real kind of negativity bubble here. When we look at the market, just kind of going down, S&P just kind of grousing around 5,000 here. Not a lot of anything really happening. I think when we look at this right now, there's actually some negativity about geopolitics just kind of weighing on things right now when we look at the market overall. I'm going to first start out by showing you some standardized returns of some ETFs that we may be talking about. Sometimes we use ETFs here on market trends to kind of just assess what different areas of strength in the market are. And so we just want to show you those standardized returns. If you go to the article in question, let me actually just quickly show you how to get to it. If you're on tradestation.com, basically if you're on TradeStation and then you go here to if you go to Insights, we always have this. Here's our article right here. Rates geopolitics cast a gloom before earnings. Market trends this week. Also, in this in this article, we have a link to a zip file. And if you want to actually use some of the work, the spaces we're working with, some of the tools we're using, if you go to the zip file, this is what it looks like. If you go into it, it says MT public materials. Inside of there, you're going to see a series of workspaces and a series of ELDs. And what you want to do is you want to double click on the ELDs first. That will import studies into the TradeStation platform. And then once you have them in the TradeStation platform, you can use the workspaces, which are these things marked in blue. Today, we're going to use three of them. We always use MT main to start, but this is more or less how it works. Like, for example, if you're going to, double click on this, it'll bring up a dialog box, right? It'll show you the indicators included in that ELD. I already have them. I'm not going to mess with it, but you could just hit finish it, and it will import them. And once you have those, some of these indicators we use, like, for example, 21 day or 10 day or whatever. Once you've imported those in the ELD, then the desktop and the workspace will function. So I want to start out with MTES. This is one of the workspaces we actually share. And we'll just kind of show you right now. This is an hourly chart of the cash index and an hourly chart of the futures. If you first start here, you can see this back here was a gap from February 22nd when NVIDIA reported earnings. And you can see on the hourly, you can see that gap, and the market had that big run up, and now it's kind of just pulled back. So this just kind of shows here how we've come back and tested some levels. There were some important levels like last week when we basically broke under that April 4th close, and the market really accelerated downward after. Now, if you look at our S&P recap, which is another article we do, if you actually look here on our Monday article, basically in this article right here, stocks have had a healthy pullback. We identified some levels, and one of those levels was 50.57 on the cash index right here, in this chart right here. And so what's interesting is if you look today, 50.57 is pretty much that level that we've been trying to hold. It was more or less, this was a weekly level from early March, that we had gone down and held, and now it's we tested to the upside twice and failed. You can kind of just see that. However, at the same time, this could be just a period of kind of basing and bottoming. What is interesting here is we're not really seeing a lot of just kind of accelerated kind of follow to the downside. In my view, when you look at something like the kind of geopolitical situation we have right now, these are often the sort of situations when you will actually get this kind of just kind of despairing gloom, and everything feels terrible, but you look and it's like, oh, we're down 0.1%. we're down, less than 0.5% or something. And this is often, in my view, what it looks like before you can get a kind of relief rally when suddenly it turns. And that's actually what it looked like in the market back in late October, where it just pushed lower and pushed lower. And suddenly it just turned. And a lot of that was because also the news wasn't as bad as people felt. Now, there are some reasons now for people for things that have been negative. We have had problems with higher interest rates. We have had the situation with inflation not being terrific. However, not everything yet is at that point where necessarily I think people would say that it's going to be the end of the bull market that we've seen. The S&P is still broken out to new all-time highs, and this is a pullback, the first significant pullback we've had since that happened. So at this point in time, if you're thinking from perspective of 6 to 12 months in the future, the question is this that opportunity that people will be looking back on as being that great opportunity that the market gave us. So I want to just show you some of the things first using these workspaces that we share. We don't talk about this workspace as much, but it is interesting, especially when we're in a kind of market environment that is more dominated by the overall index and just the market kind of moving together, like when we see a move to the downside. And I wanted to show this tool right here because this was a classic sort of sell signal. If you look, what we have is we have the stochastics here, which is this blue line had gone up near an overbought level. Not exactly, but it was definitely toward the higher end. The blue was toward the high. And then the 50-hour moving average was falling. And we use this indicator here, which is MA speed, to basically show that it's negative. This is basically the average, and the histogram is the change of each bar. Basically, how much did the 50-hour moving average change from one bar to another? So you can see here when it's falling more sharply, it's more negative, and you can see it flatten out here as it flattens out. And you can see here actually that the rate of decline is slowing at this point in time. However, it was negative, and we went up to an overbought condition. Now, the way I have used this indicator in this workspace is when two of the three point in the same direction, that's a potential signal. So overbought is a bearish signal. Falling 50-hour is a bearish signal. Two of the three lined up, that is a potential signal. However, now we're at a spot where we're back to kind of oversold. And let's just kind of see what happens. I think right now there's a few sort of things happening here. And I think, 5,000 doesn't have any exact technical importance to the S&P 500. However, it is 5,000. It is a kind of important number just overall. The other thing is I'm going to look quickly here. I'm going to just change this actually really quickly to a daily chart and show you because we've retraced about half, a little more than half the move if you look on the breakout. This was really the breakout right here. So we go here to our drawing tools. We go to Fibonacci price retracement lines, and we go, let's just drop from right about there. It's about, well, now it's a little bit more than half. What I did was I had looked from the day before the breakout, and we're actually down. We've retraced a little bit more than half. However, we've retraced about half, and this is also just something I think to bear in mind. I think right now we want to just kind of realize that there's a bunch of stuff happening in the UN between Iran and Israel and stuff, and all these sort of this rhetoric and everything happening. And at this point, to me, there's no real clear signal, but I think it's important to realize that we now have a condition in place, which is something of a potential for a real. It is a negativity bubble we're seeing right now. If you look at the AAII sentiment survey, it is the least bullish since early November or late October. I'm not sure how far back we want to look. We look at AAII, this survey, AAII. We look at the sentiment survey. It's an interesting thing to kind of look at here. And if we look at going back, we can see now we're under 40% bullish. We haven't had that in a while. This 38% bullish is, the lowest since, this show. You have to download the spreadsheet to see more. But, this is really the lowest it's been since November 22nd or going back. I'm pretty sure if you go back to early November or late October, it was lower than that. But it just kind of shows we're at a spot here where we are the most pessimistic that we've been. Now, if we look over here also in MT main, we can load up our earnings date. So we go here. These are just some of the upcoming earnings. But if you want to do this, for example, I can just go here and bring in the something like, I'll just bring in the Dow because it's not a big list. I don't want to be too slow about it. But you can just start to see some of the upcoming earnings. If you want, you could add some other companies here that are not in the Dow, like Meta, Amazon, Google, Tesla, AMD, Nvidia. I'll just add those real quick, and then what I can do is I can kind of just see upcoming earnings, and you can see now that these guys are coming up. So then the question really becomes, with the approach of the earnings like this, do we get to a spot when we're close enough to earnings and people start to react to them more? And I just think right now this is one of those days really that it's just kind of frustrating, and it's a day it's easy to lose money and not really accomplish very much of anything. But I think it's important to recognize the setup we're in, which is one of a negativity bubble is kind of growing here. And if the geopolitical situation, if nothing bad happens or things kind of stabilize here, I think we're in a spot where we could look back and actually see something kind of like we saw back there in late October, because of the fact that some of the breadth measures have gotten really an extremely negative. So I'm going to show you, for example, if we go to our MT breadth, we can see now this measure of companies above the moving averages. 34 companies in the entire S&P 500 are above their 20-day moving average, and less than a third are above their 50. So if you look at this long term, this is the MT breadth workspace that we have included in the zip file. You can see here that these are back down to levels that are pretty low by a lot of history. And again, these are not necessarily going to show any kind of immediate turn, but I think it's just important to realize that this does show at this point that everyone is just kind of the excitement and is hit a wall, and now we're at a spot where everyone is just nervous and scared and waiting, just sitting and waiting and not wanting to commit to anything. However, that can be what we see before we suddenly get a rally. It kind of reminds you like what we saw before an election or something like that. So I just think it's important to keep that context in mind. I want to show over here on a trading view chart next. Um, we actually had there was a bad data feed, and it messed up the history for the Treasury yield index. But I have it here on TradingView. I want to show you here, and basically, there's a gap right here from when the market really started rallying on November 2nd, and the 10-year is kind of sitting at it. So I think it's important now, in my view. The 10-year is a very important thing to be watching right now. And what we see is, if we look on the daily chart of this, we can see that there's this kind of uptrend in place in the 10-year. This is a 10-year Treasury yield. And if you really look, there's a level up around, we did an idea on TradingView about this, but there's a level up around 530, which is up around here, which would be the next logical stopping point. So in my view, this is something that is another sort of major risk to have in mind. And it comes down to, earnings, or the rising yield, or geopolitics. These are all sort of things that can, uh, at this point, um, you know, determine the direction we're going. I think at this point, we also have the GDP coming up on the 25th and the Fed meeting on May 1st. So these are all different kind of catalysts that can be pulling sentiment, and potentially be impacting something like Treasury yields. Last week, for example, we had a bad Treasury auction. We also see evidence of wider fiscal deficits, and if those things continue, this is also something that can, pull Treasury yields higher. There is a part of me that believes that we are entering, or have entered, a bear market for treasuries. And if that is the case, that is a potential problem you know, for stocks overall. But the thing is that it's not really clear how exactly that plays out over time. And if the Fed does cut in some ways, what it really does. The United States fiscal deficit is really starting to widen now, and we're seeing movement in things like gold and silver that are unusual and suggest that something bigger is happening. However, this move has gone now one way for a while, and it does create the potential of things swinging back the other way, at least for a period of time. So I think we want to just recognize the fact that there is signs right now of, some real sort of underlying weakness in treasuries and what that's going to mean for yields over time. However, near term, we do have a market that is in a real pit of despair, and at the same time, some potential catalysts are not that far away that people historically have been positive about. Things like Meta earnings and some of the other tech earnings, Amazon, Microsoft, things like that, which have historically been positives for the market. And so I wanted to just kind of point that out. I think we kind of balance between those two different things now. The other thing to remember is that the S&P now is down for 5 straight sessions. I don't have it right here, but that's the longest losing streak since here. You can actually pull up. There's a tool we have called Price Streak that you can actually see. It'll show a histogram of consecutive days up or down. But this was a 5-day down move, and now this is 5 days down. So a 5-day losing streak on the S&P is a pretty unusual thing. And I think when you consider the overall positive momentum and everything else, it might be something also where when you consider that short term we have a bearish sort of trend, but longer term we don't. And the other thing is that we have broken out to new all-time highs. So when you're in a sort of breakout, very often you don't get that sustained move to the downside. We need to build some sort of technical structure in terms of a pattern of lower lows and lower highs before the real breakdown really comes. Now, of course, that is assuming that the geopolitical situation doesn't take some horrible turn for the worse. Again, I think the market, I've always said the market is not really capable of pricing in real geopolitical crisis. It's capable of pricing in higher oil prices and stuff like that. But when you're looking at a sort of binary event of something that could be like a big war or something really, dangerous like that, the market is going to just be kind of paralyzed and hope it goes away. That's normally the way it behaves. So let's go now and look at some of the other things that were interesting. I looked at the 10-year. I wanted to talk about that and that gap from February 22nd. I'm going to just quickly zip through now and show you how we use this workspace overall. MT Main is the main workspace we use, and this is radar screen. And what I like to do with this is kind of look here at our different areas of relative strength. And if you look at the market here, like for example, in the last month, we can see here is that metals are the top performer, which is kind of interesting, and energy. Now, we actually did a social media post today about XLE kind of pulling back and touching these levels. Now, last week when we did this webinar, we were talking about the potential, like XLE was up there at this time, and we were talking about, maybe thinking about things like Keltner pullback and some of our moving average test indicators that we have built into this workspace. So, for example, we have things here like on our price grid, we can see things when they pull back down the Keltner channel. We've shown you that. I'm not going to go into that today. Well, actually I could. I'm going to just quickly load here. I'll load the I'm going to load the S&P and we'll come back to it and you can see what I mean. But this is the sort of thing where this is the sort of potential pullback that we, have been kind of, saying might happen, and here we have it. The energy ETF is pulling back to its high from last year. And what's interesting is if you look at this on like a longer term, this is basically now near its kind of all-time highs from way back in like 2014. It's actually easier to just show you on trading view really quickly. If you look here at XLE and you look at this, this is basically a level from back here in 2014. So if you look at this, this is a very significant level it's gotten above this 94 level. It really is the high going all the way back through 2022. So what's interesting is if we look here in our key ETFs, we can see on a year-to-date basis, energy is the top sector overall, followed by communications. So that's an interesting thing to kind of see. And then you can see on here, semiconductors are the top industry, but energy is now the leader. So it's interesting to see we have our leader for the year that has relatively tight inventories. And the other thing is we had different economic news recently, like we had the Chinese GDP was stronger than expected. We had the IMF raising its global growth forecast from 2.9% to 3.2%. We had, some other economic news. What was it? There was something else in the U.S. today that was this week that was good. I don't have it right in front of me. We had retail sales. I'm sorry, retail sales much higher than expected. All those sort of things, point to the direction of demand for energy. So, I think a lot of this right now, if you actually look, let's take a look at crude oil futures because they had a really interesting pullback here. And let's see now how they're kind of holding. Again, look at our Keltner channel. They went right down near the bottom of the Keltner channel And now we have this level from late March, and now potentially does this turn into a higher low? I think it's important just to see that. We've been kind of talking about energy here for a while, and I think it's interesting just to see the kind of pullback we've gotten in it. Because in my view, even if the geopolitical situation, doesn't pan out for the worse, the fundamentals here with a strong economy and tight inventories, are not necessarily bad environment for energy overall. And it's also seasonally a time of year when people look for that. So we want to kind of keep our eye on energy. This is what we want to do, though. We want to think about using radar screen to identify areas of strength, and then also identifying, opportunities in terms of pullbacks and things like that. I want to look at the XME because this is actually starting to do some interesting stuff. Metals are similar to energy, and if you look at the energy, the metal ETF here, this is also something that is trying to kind of find support, kind of near its highs from last year. So this is also here something where an economic play. It's a sector that's been out of favor for a long time. It's probably not as widely owned. So again, this might be something that people are starting to kind of look at and think about maybe for the first time in a long time. All right, so some of the economic news I'm going to actually, no, I'm sorry. Let me just kind of show you here the you can just see here where the performance is. And if we just look in the last week, though, we can see a lot of these have really kind of pulled back. In the last week, every single sector is red, with technology the worst, and then real estate and consumer discretionaries. Now, remember, consumer discretionaries are Tesla. That's really what is causing this weakness. Tesla reports earnings soon, and this is one that we have been noticing. The chart has been telling us what Dan Ives didn't want to tell us and what the bulls didn't want to tell us. We were doing reports on Tesla going into distribution back here, basically on the breakdown to the 200-day moving average. But now we're at a spot where, it's now basically down to the level that we had been identifying. And at this point, it's not really clear to me, what exactly to expect from Tesla when we actually see earnings coming up. There's a lot of negativity in this, and there's a really sort of actively traded name. But this is, earnings coming up on the 23rd. But Tesla is contributing to a lot of this overall weakness. The things that really look to me, though, when I look at the overall, situation, is the pullback in things like energy and the pullback in things like industrials. Some of these here are the cyclical areas. They are pulling back now. And what's interesting is we're seeing some inside days here. And so I think this is now something to just kind of watch and see if we get some resolution to the upside. Another one that was very interesting to me was Wells Fargo. This has been a name that's been a turnaround, and if we see this breakout in it, this is one I think that is kind of moving on its own. And I thought this was one that people might maybe want to be thinking about. There's something happening with Wells Fargo here. At this big rally right here after it was something to do with its old that whole account scandal from many years ago, but it kind of was another phase of the regulatory situation clearing up. It had the rally on that, had this tight consolidation, reported earnings, and look how it just moves sideways. Other stuff moved down, it moves sideways. Tight sideways consolidation is usually a sign that there are no sellers, and that now it's interesting. You can see there's a little bit of a falling trend line there that we are, you can see this potential kind of breakthrough that. So I also want to point something out here. We go to I'm going to go to fundamentals, and I'm going to bring in the whole S&P as well, because when you talk about Tesla is now falling behind on market cap. And so if you look now, look at where Tesla is now, all the way down here. Tesla is only 15 billion ahead of Walmart. It is a smaller market cap now than Visa, Broadcom, Eli Lilly. So, it just kind of shows, how the market is changing. I want to just point that I thought it was kind of interesting. At one point, Tesla was up in the top 3 or 4, and now here it is under Visa. And I think that it says a lot. But like I've said, Tesla is ultimately to me, consumer electronics, I know it sounds maybe a little bit extreme to call a car consumer electronic, but it is essentially what it is. You know, there is a history that's existed my entire lifetime. And I remember when I was a kid when digital watches were expensive and I thought they were cool. And then I went back when I was like 20, something in the mid 90s, and you could buy them in, Times Square for like $2 or $5 or something. When I was a kid, those same watches cost 30 or $50. Consumer electronics are a race to the bottom. And ultimately, I think that does apply to Tesla. And I think also what's important though is that it also applies to Apple. And I would say if there's anything that you can say about Apple is that it's amazing that they did as well as they did for as long as they did in a vertical that is actually such a bad vertical. It's a consumer electronic. And I think now Apple is in a spot where we had talked about it holding this level around 170, and it did. The put spread we had kind of, mentioned as a possibility, would have worked out. But now I think we have to realize is that Apple is just in a kind of bad spot. Now, they're actually, there's something I was going to get to, but I think they had a delay in their one of their AI things I'm going to get to, but it's just kind of interesting that Apple here holding this level. In my view, though, look, it rallies up, makes the lower high, it's trying to hold this level. We've talked a lot about the fact that this stock has not gone to new highs when the S&P has, and that says a lot. The same way that Tesla's chart told us bad fundamentals, it knew about the bad deliveries before they happened. The same thing I think now when we look at Apple. So, in my view here, I think we need to be careful that Apple has lost that love and feel, and maybe it's kind of it had that time when it had that kind of it was bulletproof, but there's evidence that that's no longer the case. All right, um, let me look at the next thing. Let me now go through some of the big news that I thought was interesting that I wanted to kind of zip through and show you guys. All right, IMF raises its growth forecast for the world. It basically cites the United States and China. Just an interesting one there. ASML had, bad news on semiconductors. I'm not really sure what to make about that. This is kind of like an applied materials. It's actually a Dutch company, but it's a big name for semiconductor, supplies. My view now about something like semis, you got to just be careful because if you look back um, to a period last year, we had that big rally in the spring on AI, and then there was a period of sideways movement. And I think right now, when you look overall at something like let's look at the Philadelphia Semiconductor Index. Oops, dollar sign SOX. You get these periods simply of consolidation. And one of the things I was kind of thinking here is if you actually look back at the overall market, if you look back to this period here, last year, basically kind of in April and May, we were waiting for them to raise the debt ceiling. We were, waiting and grinding here before the market rallied. And I think it's important to realize now that we could enter a period here where we maybe consolidate for several months as we figure out, does inflation get better? And if it really doesn't and yields really run away, then maybe that's when bigger problems occur. But I wanted to kind of point that out that, at this point in time, after 4 months of upside, we could have a period simply of consolidation where we try to figure out whether or not inflation really is coming down. There's arguments both ways, and I think one of the things is when you look at something like the information about insurance, it's kind of frightening because you have these embedded inflationary pressures. But at the same time, we have that normal seasonality in the beginning of the year. And as they say, bull markets climb a wall of worry. We're not economists here or anything like that. And the thing is that a lot of economists, they've been wrong one way or another. And it's just that whenever you feel everyone is leaning in one side, now it's, everyone is so hawkish and things are never going to get better. That's often when, the market will go the other way. So I think we have to realize here is that we've now priced in We price in a lot of improvement, and now we have a lot of anxiety and fear, and it could simply be a period of consolidation for a while as we kind of work those things out. And then when you look at something like the semiconductors, it also could be a period of kind of consolidation when it basically has, 2 quarters up, 2 quarters sideways, 2 quarters up, 2 quarters sideways. And right now we've had the 2 quarters up, and we could be entering a period of 1 to 2 quarters of sideways movement as we kind of consolidate. So that's kind of one of the kind of perspectives I'm looking at here. And if that is the case, then the question is, where do we get our short-term momentum? And that's why I was looking at things like energy and things like metals and stuff, because that is what radar screen is telling us has the short-term momentum, and it also matches the news flow of the GDP being revised higher, and this matches the price action of semiconductors kind of having their good news for now. I thought this was interesting, though. Of all these, there's apparently a lot of bad news right now for insurance. And when you actually look at the fundamentals of the insurance industry, it's not that interesting overall of an industry. But the thing is that they have a lot of these losses, and at the same time they have inflation of it costs more to fix stuff, and they have more losses to fix. So that's one of the things that's driving. I thought it was interesting to see that Travelers basically in their earnings report that they mentioned that. Um, so I thought it was just the IMF saying it would take a lot to derail the economy. Um, and it's interesting also that they see an acceleration in China. Um, I think that's also something to keep in the background. We were very wary about China many months ago, and it more or less panned out correctly. And at this point in time, though, again, it could just be something where it's a pendulum that swings back and forth. But again, if we are seeing this, right now, an awareness of a stronger economy, that also fits into the energy and commodity sort of concept. Okay. This is interesting about copper. Copper prices, as there's data showing Chinese smelters are not as active. So there's been a thing now where people are talking about Chinese production, and they look at these the smelters in China. This was actually the thing that launched. We were talking about Freeport back here, FCX. Now remember, there's only really a couple of copper stocks, and Freeport is the real liquid one. We were mentioning it somewhere back around here, where it started to rally. And then it's interesting, the market kind of knew this was coming. And then I think we talked about it here, and I think then the Chinese cut production of copper, and then the stock launched higher. And HG is the copper futures. So anyway, I think this is just interesting to see now when you look at something like copper. Again, if you look at this on a longer term, um, there could be arguments of this. Just you could see that there's space on these charts. And the thing is if we have a strong economy right now and China's strong and they're cutting production of copper and things like that, these are the sort of things that this is where the short-term strength is. All right. So the copper thing, it's this. Bank of America had losses on credit cards and office loans. So I think this is also something here that we have to be aware of and recognize that this is one of those real risks that is out there, which is that if the 10-year treasury keeps moving higher, commercial real estate, will have more issues. It's highly likely. There's a lot of people talking about this. Here's Sheila Bair, who used to run the FDIC. She basically was saying the same thing. I'm worried about regional banks. So remember, higher interest rates mean that these properties that they finance them at like 3%. Now they have to refinance them at like 6%. That means the property is less feasible economically. Maybe they have higher vacancies because of less demand for office space. You put those things together. Maybe those properties are not worth what they were. Turns into losses for banks, things like that. So again, regional banks are the focus of that. And it's just something that's out there brewing. It's not to say that it's going to cause another crisis. It's just that it's out there as a drag on the on this part of the market. But it also means that there is going to potentially be a spot here where these financials are interesting. I do think it's important to realize the United States is a strange country for banking, because you go to most other countries, they don't have a million little banks. And we could be moving toward a spot, what Sheila Bear basically said, where a lot of these small regional banks simply go away and we see a concentration in the bigger banks. So it's just kind of interesting just to be aware of. It's possible these regional banks never will have an opportunity. They all just kind of, phase out over time. But the thing is when you look at something like Wells Fargo, and then you also look at what I thought was interesting here. I was looking at things like Citi, JP Morgan. These guys have pulled back, and I'm just kind of watching them because again here, they're at a spot where if you look at the moving averages are coming down, the short-term momentum is not positive on them. But these are ones that I think we want to kind of keep on our list and start to see if we actually get, stability, and then we get to a spot where maybe we get past the Fed. Maybe these are names that after the Fed, there's a relief rally in them. So you start to put them on your list. I always keep a list of things with time. I have like tasks for different dates into the future, but I also have sometimes ideas around, specific events. And it could be something like that, just to think about post Fed. If we actually maybe see a drop in rates, that could be a return to some of these big banks that now have the short term momentum. But 12 days from now, after that Fed meeting, some of this, if they hold, can kind of, that short-term momentum would no longer be as bearish. So I think JP Morgan here, something like this could chop around an area like this for a while. And it could be something to kind of keep on the list. All right. Whoops, wait a second. That was the regional bank thing I wanted to talk about. Let me close that. What is this? This is just the same thing. Properties are generating no cash flow at all. There we go. This is from CoStar. All right, what's this? Mohammed Al Arian says, all right, this is interesting, just showing how people have run down their COVID savings. I'm not sure. Again, these people always say things like this, but retail sales continue to perform. I want to just kind of point that out. So, Elon Musk with his pay package, again, these are just now the problem with something like with Tesla, is that when things are good, and I think it's important to realize with anything like this, when things are good, they're very good. But then when things are bad, not only do you have bad EV sales, you also have things like these kind of weird fights over people, these drama, these sort of personal issues. But then on top of that, you got to realize Elon Musk has borrowed money against his Tesla to do other stuff like buy Twitter and things like that. So, these things just tend to cascade in one direction or another. And I think that, again, Tesla's at a spot now where it's not a value. And the problem with something like this is with the valuation still high and the business weakening and companies like Toyota and Ford stepping into the space that have more of an established sort of network out there. A name like Tesla, I think one of the big risks is trying to see it as a value stock too soon. Because I mean, if you actually look at it, if we go to our fundamentals grid here, let's actually look at fundamentals. Let's rank members of the S&P 500 by revenue. Let's see where Tesla actually falls. Wow, I don't even see it here. Let's see where Tesla's at. I rank now by market cap. Tesla, here it is. It has revenue of 96 billion. So that basically means that it's pretty far down the list here. I mean, Tesla is, under Target. For example, Target trades for 0.7 times revenue and Tesla trades for 5 times revenue. Now, in comparison, where's GM or Ford? GM is up here at 170 billion of revenue, and they trade for 0.3 times revenue. So Tesla still trades for 5 times revenue, and GM trades for 3 times revenue. They both trade for 0.3 times revenue versus Tesla at 5 times revenue. So again, the great thing about TradeStation with its award-winning platform is that you can do this sort of really quick analysis. Now, we're not interested in just doing analysis all the time, looking for opportunities to make money trading. But the thing is sometimes you just need to know something like that really quickly. You're like, how overvalued is Tesla? And you look at it and you're like, well, maybe, just to kind of realize that if we compare it to its peers, you could make an argument that it's still not very cheap. And that's a useful thing to always have to just jump to. And that's why we've set up these workspaces. So actually, let me just jump back over to our price grid, because I did say I wanted to look at, this is an example here. Just want to quickly show you. I've also talked about Keltner channel pullback a lot, but if we look here at things that are kind of down the Keltner pullback, this is just how it works. So if you look here at something which has a 0, So, for example, right now is zero is I don't know. Oh, Eastman Chemicals right at one. This is one that we talk about. So see, it's touching the Keltner channel. So the pullback thing tells us one. That basically means that zero is the bottom, 100 is the top, and then it can have values above 100 or under zero. But basically, with the idea of the Keltner pullback tools, that it basically tells us when stuff is getting back down into a potential area where it may have had a pullback that people might want to think about buying. So basically, this is just one of the tools that we include, and that was what I was talking about. I just want to just illustrate that. I had mentioned it earlier. All right. Another article here. Carl Quintanilla. This thing that the JP Morgan that they're increasingly worried the Fed is going to have to make a hawkish pivot. This was after the retail sales. And I will say that I am increasingly worried about a bear market in treasuries. One of the reasons is that treasuries it's probably the longest, greatest bull market in all of history, going back to the early '80s. And I think we have to realize that everything that we know as Americans sits on top of treasuries, whether you like it or not. Borrowing costs, but also, the basic thing that we call dollars in one way or another is linked to, treasuries and treasury bills. Anything we have that's associated, with borrowing or savings or anything, it's completely intertwined with the treasury market. And if we start to see the treasury market going into more of a structural bear market, and we start to see more issuance because the government's running bigger deficits, over time, that has negative implications for equities. And I think we have to, bear that in mind. And it is a possibility that that is happening right now. But it's also important to realize that if that is really happening, it's not going to just be instantly everything goes to like 10% on the 10-year or something. But if that really is a sea change that's happening, I think we have to, respect that that is a possibility. One of the things that Mark Douglas talks about is to recognize not the things that you want, but the now moment, what is actually happening for real, not what you want to happen, but what is actually happening. And I think it's important to realize that the chances to me that we're entering more of a real, sort of time of longer term increases in rates and, weaker demand for treasuries. It seems to be kind of happening, and I think you have to realize that will have implications. This is just something here where this guy Ryan Dietrich, talking about how basically, when the market has a really big move, if it's up 28% in the last 12 months. What happens after these big months, of winners? He says it normally continues. So Alwyn just mentioned that he has been pretty bullish. He's been right about it from the lows back in October. But he also does have that bullish slant. However, now this is another thing. There was good demand for the 20-year auction. So, it's not like it's just one thing decidedly one way or another. But I just think we have to realize now that that 10-year is a big deal, and we do need to watch it. This was something though that is, maybe a little bit of a ray of hope. They said in the Atlanta Fed business inflation expectation was lower than expected, and they said unit cost growth significantly decreased. So again, there is that idea that we see hotter CPI at the beginning of the year, and then it moderates. So again, now that this is actually for the month of April. So remember, data comes out in April, and some of it's April data, and some of it's March data, and even some of it's February data. So you just want to realize where exactly you are. This is also just for energy. I thought was interesting that they were going to have oil sanctions put back on Venezuela. We talked about back in October. It was funny, when all the initial sort of like tension was happening after the attack on Israel on October 7th. There was this jump in oil, and then about 10 days after that, we did a post on Market Insights, and we kind of said, despite all of this, things are actually turning ugly for oil. And it turned out to be more or less what happened. One of the arguments, or one of the points that we made in that, was the United States was lifting its sanctions on Venezuelan crude. And now it looks like they're going the other way. So some of these things also, again, are just kind of important, I think, to realize the situation for energy. So here's one that I thought was just kind of interesting: a double upgrade on eBay. Now, as you guys know, and I'm not going to get into it here, um, or I'm not going to link to it, but if you go back and look, we have historically looked at what we call the seven catalysts of stock movement. And one of those is business transformation. When a company does something strategic to change their business model, and it might be something really small that sounds kind of boring. So, for example, the key thing to look at is for language like this, they're shifting their strategy to focus on cat. I don't even know what this means, but what matters, but the thing I know is shifting its strategy. And also, they have the magic word of AI features. Now, again, I can tell you that I can do a little bit of software coding. I'm kind of like, maybe a second grade level. I can do a little bit of stuff on my own, but I can tell you I've become a much better developer in the last 3 to 5 months. And it's because I've been using Chat GPT. So the thing is it does make a difference when people use AI. I know it's become this word. Everyone just says AI this, AI that. But the fact is, if you're a company like eBay, there are opportunities out there. Meta is doing a lot of very subtle things with AI that has really moved the needle on the performance of their ads. And so eBay, they have a lot of traffic, a lot of categories, and if they can just move the needle a little bit, it can make an impact. If they use some AI to say, here's a guy who you can increase his monetization by a little bit when you have a lot of volume. If you move the actual, you know, um, profitability a little bit, it actually can make a big impact on the ultimate profitability. So to me, this is something that's interesting. Now let's take a look at eBay because the last earnings report on eBay was pretty explosive, and it rallied, and now it's kind of pulled back, and this it jumped on this upgrade today. But to me, this is a name that I think we really might want to be thinking about. Look at how it kind of held this level here. I gotta say, look at this candle. This is a kicker. Basically, it hits a low. It's like a despairing, kind of, miserable low. Things were so terrible, and then it comes jumping back the next day. This is a bullish candlestick pattern. This is called a kicker when it closes down there and it comes shooting right back up. Now, it didn't just completely clear the candle, but I think the key thing is that it went down to an old level, which was this level from back here in July, and it came flying back. So to me, what's happening here in eBay might be kind of interesting, and it might be a name that we want to look at. Another transformational name, or not transformational, but a story name here is First Solar. First Solar basically has been there's the idea that the government is going to have tariffs on the Chinese solar panels. This is a name that people consider like a real sort of like, if there is like a blue chip or, a real dominant American domestic producer of solar panels, it is First Solar. It was historically one of the better performers. The solar industry has been really bad, but this is an election year, and this is maybe something that you do start to be see more of an issue. And if we see talk about green energy and all that stuff into the elections, there's a few ways for investors to play it, and First Solar might be one of the cleanest ways for them to play it. So I wanted to point that out. Look at how it broke out above this high, held that pullback. This is an interesting name. Also, we did a trading view idea on this if you want to look at that. If you go to the blog post and you click on the link for trading view ideas, you can see, but it had a bullish earnings report right around here, a bullish earnings report, I think right here. But we have it all in the trading view idea. But the last two earnings reports have been better than expected. Now it's breaking above the old high. And I wanted to, point this one out. It's not terribly different from the eBay chart. We might simply be, this is what happens if the market does move sideways for a period of time and it doesn't massively crash, but it just moves sideways. There can be individual names that run in that time, and those can be based on individual company stories, like maybe eBay has or First Solar has. Valero, this is just interesting also. We had kind of talked about the refiners a while back. They moved and now they've pulled back pretty sharply. I mean, this is just I mean, I'm not sure exactly. They just pulled back more than I expected. And I think these are maybe now kind of more like JP Morgan, but I don't know. I'm not sure at this point when you look at this thing technically, there's no clear opportunities on it. But these names have moved and I don't know. I'm not sure exactly to make this one technically now. Um, but there was this upgrade of it. And the thing is, energy at this point in time is an area that it has that momentum in it. And let's see if if things stabilize here. A lot of these are maybe things to simply watch for the time being. This is also interesting. United Continental and Alaska Air both had some strong results. Um, what's interesting about names like this is you're basically seeing, I think, the underlying business is doing better. And these are also companies who do large volume, and if they can have small improvements on their profitability, they can have sort of big kind of turnaround. So it's interesting, I think, that the strength in these airlines here recently, I think, are some areas we might want to also, again, if the market is a period of consolidation, relatively obscure areas that are not as big in terms of the market cap weighting can actually, have some moves. And I just think it's important here to realize that these airline stocks have been reporting strong earnings, and a lot of them also are economically sensitive. So if you have a strong economy and things like that, let's look at things like United. I mean, it's a really strong sort of jump that it had here on earnings. And obviously at this point, you can say it's probably overbought. If you look at it, it's way above the Keltner channel. I mean, there's a lot of arguments here that you could say that this is near term overbought. But these are areas here, I think, where things like the airlines overall, we might want to be thinking about those a few weeks from now if we get some pullback or consolidation. The other thing that was just kind of interesting was Micron. There's another thing was getting some grants from the CHIPS Act. Now, like I said, I use radar screen to basically look for relative strength. I like to focus on relative strength. Like we said, year to date, semiconductors are the best, but if you look in the last, month, they're down 4%, which means they're lagging the S&P. You can see the S&P is down 3.2. Chips are down 4%. So that is lagging, is underperforming in the nearer term. So, I mean, this is now an area of kind of weakness. I want to just point that out, the thing about Micron here. Um, it was just another sort of name that was interesting. I think just right now, the thing with semiconductor, like I said, is if they enter a period of sideways movement, you know, it's just something to look elsewhere potentially for sort of opportunities, and that's why it can make sense to use our indicators here and to actually look where the performance is. Where is the zip file mentioned? Okay, if you go back here to, let me actually just close this, and I have, all right. This is our blog post. If you go to tradestation.com, I'll just show you again how to get to it. If you go to tradestation.com and you go to insights, and then you go to this blog post about our about our webinar today, the S&P just kind of grousing and trying to hold yesterday's lows. I didn't see much. There was stuff happening in the United Nations, a bunch of rhetoric. Downloads are available here. It's this zip file, and if you open it, you will basically see this. You go into this thing called public materials, and this is a zip file. So, all right. I want to end by showing you guys this other tool. It's called MA Speed. So we showed you here the S&P, this chart, which shows it uses this thing here, which is called MA Speed. See, MA Speed. Now, this is on a chart. So it behaves a certain way on a chart. We're going to use it here in radar screen. So I'm going to just very quickly pull up a radar screen, and we can go to, I'm going to just bring in really quickly, like I'll bring in the Dow. And then what I'm going to do is I'm going to change it to daily time interval, time frame, change it to the daily. And then what I'm going to do is I'm going to go to add study, MA speed. Now this can be used for finding kind of short-term momentum. Now you have to change it a little bit because it's set to work a certain. I designed it to work on the chart, but you can make it work in radar screen too. So see, it shows a bunch of zeros. All right, so we want to click on this. Let's actually just make the page and make the font bigger. Let's just make it big so you can see it really easily. All right, so it's called the MA. It doesn't really matter which of the two we look at. Let's go now to our studies, edit MA speed for all symbols. Now, the first thing is on the general page, when an indicator doesn't work, you often want to look here and make sure it's loading enough history. So in this case, let's force it to load 55 bars of data just to make it easy. It'll force it to hold. Now, the next thing is I'm going to change it to something like the 20-day moving average instead of the 50, because I don't think the speed of the 50-day moving average matters. Remember, it works on the other chart on the hourly. So, all right, so let's say the 20-day moving average. Now let's go down here to our style, and you'll notice that it shows a 0, but we want it to show as a percentage. So I'm going to click on this and go to percentage, and click on this and go to percentage, right? And now I'm going to hit OK. And now it's going to recalculate, and it's going to show me. I'm going to bring up a chart really quick. And I'm not even going to add the moving averages to it or anything. I'm just going to very quickly link these using symbol linking. And if we look now and we look at our MA change, we can see that in the S&P 500 or in the Dow Jones, Goldman Sachs has the fastest rising 20-day moving average. Now, I'm not even going to, I could add it, I guess, really quickly. Moving average, one line. And I'm going to bring that in. I'll change it to 20. And you can see now that it's rising. All right. So, and then if you look at the ones that are falling the most, we have Intel, which has just been a disaster. You can see how it's falling. So what I have found is that often the ones that give opportunity are the ones that have that quick movement. And you might even want to look at something like the 10-day moving average or the 5-day moving average. But basically, finding these names that have that movement can sometimes find opportunities. And this is the way you use MA chain. You use MA speed with radar screen. It's a potential way to look at it. And it's just another way to find direction. I have just found, I know it's incredibly simple, but finding stuff that has a quickly rising 5 or 10 or 20-day moving average can be the single most reliable form of detecting momentum. And it's not just based on the movement of the stock, like a 5 or 10-day change. What I've just found, the thing is, you can get weird stuff in there where, say, it jumps 4% one day, and then the period you're looking at moves past that. Like, say it jumped a bunch on Tuesday of last week or on Wednesday of last week, and now it's no longer in the trailing 5-day period. It might not actually show up as moving. You can get strange sort of noise when you look at even intervals like 5-day or 10-day or 21-day. But if you look at something like the 20-day moving average speed, it smooths out all of the price movement in a way that sometimes can give you a clearer picture. So hopefully that's of interest to you guys. The last thing actually I wanted to mention was, remember the big earnings coming up. The big stuff happens on Wednesday of next week when Meta reports. And that morning also, we have GDP that morning, which is a kind of big event lurking out there. So those are the main things I want to talk about. I'll be back next week. Great to see everyone. And I hope everyone has a great day.